Jim Rickards began his presentation by stating that the world monetary system is not led by the Federal Reserve but by dollars, by money that banks lend to one another in order to strengthen their balance sheets and lend to clients or offer transactions to customers if they so want. Collateral constitutes assets. Now, however, banks, hedge funds, and others are becoming suspicious or concerned about one another's credit. These are the earliest indicators of a worldwide liquidity crisis, which is distinct from a recession and what is often known as a financial crisis. Behind the scenes, there is a great demand for money that can be used to purchase treasury securities that may be pledged as security to prop up the balance sheet. It is the plumbing system. This is why the dollar is robust despite the overall weakness of the US economy, meaning downturn, long-term impairments in depression, trade deficits, a political dysfunction limit. The American Civil War. Maintaining confidence in the dollar notwithstanding the elimination of the gold standard. This is occurring. The rare ends are decreasing their balance sheets, and in his opinion, it's only a matter of time before one of the main players suddenly declares bankruptcy. They are unable to fulfill a collateral request, a bank is in trouble, or there is a run on the bank. Now we're back in 2008. This does not appear to be 2020. This would look like 2008, except worse. On the supply side, when the price of diesel increases, the price of everything on the truck also increases because delivery expenses must be factored into the cost of the merchandise. Demand-side inflation, also known as demand pull inflation, is primarily psychological, as consumers believe prices are increasing for whatever costs. Perhaps they are increasing and assuming from that, or they have other reasons to believe this. You want to purchase a refrigerator, a car, a new suit or clothes, or whatever, and you're like, you know what? I better go buy it right now because if I wait 3 months or 6 months, it'll be a lot more expensive. So you do, but you're bringing all of that demand forward, as well as your fees. Prices are rising due to increased demand. The Fed has no control over supply-side inflation. Is it true inflation or just a logistical issue? However, the Fed is powerless to intervene. The Fed does not drill for oil, operate trucks or pilot ships, and they have no control over it. They can intervene on the demand side, which is destroying demand. It also began on the supply side in the 1970s, with an Arab oil embargo in 1973, followed by an Iranian siege in 1979. So supply shocks did spill over into demand shocks, and then it just took on a life of its own. We're not there yet, but we're dangerously close. We have it from the supply side, but it hasn't yet affected the consumer side, which is why consumers are pulling their horns. There is yet another method for bringing those prices down, and that method is for the high prices themselves to decrease demand all on their own. And as a direct consequence, this leads to decreased prices. This is something that is taking place as evidenced by the fact that inflation has begun to decline after having been significantly higher than many people anticipated it would be beginning in the middle of the previous year. However, they are beginning to decrease a little bit at this very moment. However, the demand side of it has not yet reached its critical mass. On the other hand, there is one more thing that the Fed can do. They have the ability to execute demand. So, what is their secret to success here? The interest rates on credit cards and mortgages both rose, and new homes cost more. People quit purchasing new cars since finance and lease rates for automobiles continue to rise. If you do that enough, you can eliminate demand, but it comes at a very high cost because what you're doing is pushing the economy into a recession. If you do that enough, you can destroy demand. The Federal Open Market Committee is responsible for the latter action. Although it is a very imperfect and harsh instrument, they are destroying demand. Now, the question that pertains to Fed policy is as follows. Are they aware of what they are doing? There is never a yes to this question. They are always acting as though they are aware of what they are doing, even when they are not. They claim that they do it, but in reality, they don't. We are in a recession, and unemployment will begin to rise. And there has been widespread devastation as a result of rising interest rates. This could lead to decreases, and housing price inflation may level down. So, why is the Fed hiking interest rates in the face of economic weakness? They don't get it. is the answer. They are always the last to know and are highly political. We have a situation where inflation is coming from the supply side and the Fed has little control over it. They can't destroy demand, but it will cause a recession. So, why are we hiking rates in the midst of what could be both an impending recession and a global liquidity crisis, as we recently discussed? That is insane, is the answer. It is not something you should do, but it is the Fed, and they will very likely do so. The recession is highly numerical. The National Bureau of Economic Research is a referee situated in Cambridge, Massachusetts. They determine when a recession begins and ends, and thus when the recovery begins, their rule of thumb is 2 consecutive quarters of decreasing GDP. In the second quarter of 2022, our GDP fell. The loss was not as severe, but it is still a loss. GDP has fallen for 2 straight quarters. Atlanta Fed is unique in some way. By definition, the defective items will arrive later in the quarter. Thus, this was observed in the second quarter. They began positively and concluded negatively. They began the third quarter on a strong note, but the trend is currently negative. We shall see where it finishes up. Depression is entirely distinct. People believe that if a recession is 2/3 of a GDP decline and a depression is worse than a recession, then a depression must be 10/3 of a decline. The Great Depression lasted between 1929 to 1940. From 1929 to 1933, there was a severe technical recession, followed by another technical recession in 1937 and 1938. From 1933 to 1936, the economy expanded. Depression may not entail continual economic decline, and this indicates a decline in growth relative to the trend. Therefore, if your potential is 3.5%, as it likely is in the United States, it is not necessarily higher than that except for brief times. However, if your potential is 3.5 and your actual is 2, you have depressed growth. Imagine 2 curves, one ascending like this and the other like this. The difference between potential and actual growth is depressed growth. That is wealth loss. In addition, it is now in the trillions of dollars because of the recession. Currently experiencing a technical recession, we'll see if it worsens. His expectation is that it will. Since the 1940s, there has not been a depression and we are not in a recession. Therefore, choose your specialists, but the White House and government have a poor track record in this regard. As this relates to the dollar, people remark that you have had large budget deficits for some time, but they are now in the multiple trillions of dollars per year range. Prior to the Biden administration, the annual deficit was $1 trillion. You don't have a deficit when you make the loan because it's carried on the books as an asset. However, if you forgive the loan, you must write it off, which increases the deficit. So we're talking about $5 or $6 trillion in addition to the baseline deficit. The ratio of US debt to GDP is over 130% and rising. Who else has a similar debt to GDP ratio of 130%? The appropriate response is Lebanon, Greece, and Italy. Consequently, budget deficits, trade deficits, and high defense GDP ratios require spending restrictions. Why is the dollar deficit causing people to abandon the dollar like it's the end of the world? Not exactly, and here's why. There is a dollar scarcity throughout the world and many are perplexed as to why. $7 billion trillion M0 is considerably greater than his estimate of $9 trillion. The zone was recently flooded with cash and the answer is both yes and no. Yes, they printed more than $7 trillion of M0 based money. This money had no effect whatsoever. They purchased bonds from the so-called primary dealer, which consists of dealers from the largest banks. All that occurs at the Fed is that both sides of the balance sheet are strengthened. You are accumulating US Treasury securities on the asset side and deposits from primary dealers in the form of excess reserves on the liability side. Thus, money has no effect. If you insist, it is printed, but it has not produced inflation. Inflation stems from the supply side, such as the price of oil and disruptions in the food and fuel supply chains. It is inundated by inflation, which is exacerbated by fiscal policies. However, the fiscal policy of $5, $6, or maybe $7 trillion in deficit expenditure constitutes helicopter money. When the federal government, Congress and the Treasury Department hand out checks, hence they are distributing helicopter money. Well, what can you say about these details? Please share some of your ideas in the box provided down below. Stay tuned for other motivational financial videos.